Changing gears one last time, I wish I had a crystal ball. I could be clairvoyant. I am so impressed that I know that word. I could perceive what's going to happen in the future through my crystal ball. But we don't have a crystal ball. In many cases, people are beside themselves for not jumping on the bandwagon and buying a couple of years ago. Tony and Morgan in Duluth say they're kicking themselves for not buying a home when rates were lower. And with rates so high like others, we are frustrated. I'm sure that they have friends. What should we do? And the reality is, Tony and Morgan, I can't answer your question specifically for you because I don't really understand your exact situation. And I want to disclose before I say anything else that for some people, it does not make sense for them to buy a home. They're spending too much of their expenses to buy a home in today's market, which would take money away from other necessities that they need, and they shouldn't do that. And other people, they don't know how long they're going to be there. And would I go buy a home if I thought I would only be there for a year or two? I would not do that today. If I was going to be there for a year or two, I would probably go rent a home myself. Now, if I knew I'd be there 5 years, 7 years, absolutely, I would buy a home. It would be a very easy decision. So my answer for you is to look at a couple of things. Number one, how much of a discount can you buy a home for today, even if the interest rates are higher? So let me give you an example. Let's say the interest rate today is 6.75%, and you believe that if you could get something at 5%, you'd be ready to rock and roll. Well, if you look at those, and let's say you're buying a $500,000 house, and so that's 1.5%, so that's $7,500 a year. I'll let you do the math and figure out what it is per month. But if you owned it for 3 years, then you'd be at $21,500. I think I have that math right, or $22,500. Hard to do that math in your head on the air. But if you own that home and it also appreciated 5% per year for those 3 years, that means the home would have appreciated $75,000 while you paid $22,500 in additional interest. So 1.5% difference on the rate, and I just rounded it to 1.5, means $7,500 a year more in payment on a $500,000 loan. If the house was only worth $500,000 and it appreciated at 5%, which the historic appreciation rate is 5.2%, I'm not saying it's going to do that this year, but over time it probably will, then you would have appreciation of $75,000 and an additional cost of $23,000.